Welcome back to Palisade Radio. This is your host, Tom Bodrovics, and joining me today is Jonathan Davis. He's an economist, wealth advisor, and presenter of the Booms and Busts podcast. How are you today, Jonathan?
I'm very good as it happens, Tom. I'm giggling because I had a lovely lunch out in the garden. It's a lovely warm day today, and we topped it with a particularly fine Côte de Rhône. So I hope I'll still be speaking somewhat clearly to you and your listeners.
Well, in that happy spirit, why don't you start us off with a joke?
A joke? Well, as you mentioned, I do my own podcast, the Booms and Busts podcast. And I guess what came into my head was a couple of years ago when Bitcoin and crypto were having some difficulties, you may recall. I remember mentioning that Paris Hilton, yes, it is she, was launching her own cryptocurrency. And I remember I can actually picture myself physically getting closer to the microphone and saying, but that's all by the by. Did you hear that she made a sex tape in a hotel room? The poor parents, the shame. It was a Marriott hotel.
Well, Jonathan, we know you're known for your humor. And I was thinking that going through one of your last newsletters, you've drawn some comparisons to the 1,001 days in the life of a Thanksgiving turkey. And as we've seen the world change here, especially since March, we can definitely draw some comparisons to the life of Thanksgiving turkey when all of a sudden it ends. How do you see what happened and the repercussions of this crash?
Well, first of all, it wasn't created by COVID-19. All COVID did was clarify the absolute mess that global financial markets have been in practically forever. I mean, that's hardly a secret, and simply brought forward what was likely to happen anyway. We clearly, I hope I'm not teaching your listeners to suck eggs, but clearly we have a massive debt problem, government liabilities problem. But, dwelling on the problems isn't actually going to make anyone money. I know there's lots of people who make a fortune themselves, who write newsletters, who do podcasts and dwell on the problems and basically tell everyone to hang themselves. And they must invest in government bonds and invest in the US dollar. And that's the way they're going to secure their wealth. Largely, these people have been wrong for years. They got it right for a month, but we're 2 months now post the crash. And actually, it leads me to another joke, if that's okay. A recent podcast I did on the 12th of April, and remember the date in relation to what we've experienced the last few months. I remember saying today is Sunday, the 12th of April, in the year of our Lord, 2020, Anno Domini. It's a holy day, it's Easter, and the stock market has risen. And isn't it amazing how for the 2, 3, 4, 5, 6 weeks, maybe not that long, following the bottom on the 23rd, 24th of March, the word that we keep hearing, it was like Sesame Street, the word of the day. Every single time I pick up Twitter or listen to a podcast, the word was retest. We're going to go down and retest. Well, anyone can look at my Twitter feed and they'll see what I thought of that. I wasn't very impressed. And sure enough, we're around the 200 day, which I think most people would not have expected we'd have got to, although some of us did. And although very short term, after clearly a mega rise, 35% on the average, although we can reasonably expect a pause around here, the bull market continues as far as I can tell, and I see no reason why we're not going to head towards the all-time highs in relatively short order. It might be 4, 8, 12, 16 weeks, but we're heading to the all-time highs in the short term.
Absolutely. On your website, you're focused on, let's say, protecting your wealth in times when bad things happen. So what kind of hedges are you looking at when we see environments like we're seeing right now?
Look, Tom, I need to clarify what did I do. I am, in your terminology, I guess you'd call me a CFP. I'm a financial advisor, a wealth advisor. In the UK, we say chartered financial planner. I have private clients. I'm 100% advisory, not discretionary. I don't have discretion over client money. I advise them. They say yay or nay as to what to do. So in that scenario, and by the way, there's pros and cons to advisory or discretionary. I'm not 100% sure I'd want to be discretionary. I'm very comfortable being advisory. In that scenario, I'm an investor. I'm not a trader. I'm not a short-termer. My favorite character in Reminiscences of a stock operator, Jesse Livermore, is Old Turkey. Jesse's always asking the guy, why don't you come out? There's going to be a bear market. Oh, I couldn't do that, says Old Turkey again and again, because I'd lose my position. I take a long-termist approach. So you asked the question, how do I hedge? Well, if I were hedging, I would actually be buying the US dollar. And actually, I am bullish the US dollar. So with regards to the bears, there I am in agreement as it happens. I think there are too many problems with every other currency, apart from gold, the other of the two main currencies in the world. The dollar continues and will continue for quite some to have strength. But I don't so much hedge. If I were doing so, I'd be using government bonds. I'd also be using cash and indeed using an ETF in the UK, because that's where I am, where I can actually short the pound and long the dollar. So those are the sort of things that I would use. But no, I'm not using bear ETFs or fancy derivatives or anything at all like that. And in fact, I had my positions in place at the end of February, and by the middle of March, sure, we were losing money. By the middle of March, I was already writing to clients saying, by the 15th of March, Sunday the 15th, I can remember it well, we're going to see a bounce in relatively short order. And indeed, the 16th was the low for the UK market. The US went down for another week, but I could sense in the charts that I was looking at, and of course in the extreme pessimism, negativity, sentiment, extreme, so off the scale. You know, that chart that we often see banded around a semicircle showing 0% bulls up to 100% bulls. I mean, it was down at zero. I'd never seen it at zero before in 30 years or however long they've been doing that. And I've followed it. So I could sense pretty strongly there's going to be a bounce. And I waited a week and there was a bounce. And the markets have risen strongly. We've been climbing a wall of worry. Of course we have. Everyone's been talking about, oh, that's it. We've gone far enough. It's going to go back down again. No, we're fully invested. And I think the change, I know the change that we made in the third or fourth week of March was that any index-linked government bonds that we had, we sold, and they had clearly relatively well held their value, so that was good. And we moved heavily into gold miners. And in recent weeks, we've increased those further and also increased uranium miners. Now, we'll come to that in a moment. But what I'm saying is we have actually taken on a great deal more risk from the end of March onwards. And, fingers crossed and all that. But it seems to be the right thing to have done. I will just make the final point on that question of yours. Again, after such a rise, we should reasonably expect a pause. However, as Old Turkey, I'm not inclined to sell anything. I'm looking at the S&P, for example, and if I just change something on my chart to show me something. Yeah, the 50 is now turning up. The price is just below a flat 200. So the price on the S&P is between the 200 and a rising 50 below. Yes, I can see us pulling back down to the 50, which is at 27.50 or so. But, that's hardly a big move after such a big rise from the 24th of March. As far as I'm concerned, it's a bull market until it no longer is.
Agreed, Jonathan. One thing you touched on there is that you believe there's two currencies in the world. Could you explain to us what those are?
Well, I sometimes actually ask my clients, partly to find out if they've been reading my reports, to see if they understand my thinking. Because again, when you don't have discretion, you have to have pretty extraordinary buy-in from clients. I ask them what do they think are the most important currencies on the planet, and pretty well they always get the US dollar, even though we're in Britain. And some of them, I'm delighted to say, also get gold. Because why, if you weren't American or in one of the countries which uses the US dollar as your currency, why would you really want to own any other currency? If you were Chinese, why would you want the Australian dollar? If you're Italian, why would you want the Chinese yuan? You wouldn't. There's just no reason on earth to own anything other than the US dollar to trade, to transact goods and services. And of course, the other currency that, as everybody knows, has been truly a currency for at least 5,000 years. It is, of course, gold, maybe silver, but not to the same extent. Those are the only two currencies worth having, given where we are with vast government, business and household debt, what the outlook is for the rest of the year and the next few years, and maybe we'll come to that in a moment. There's only two currencies worth having, the US dollar and gold. You will always get a price anywhere in the world for your gold that's in your pocket or your US dollars. You might not get a price for the pound sterling or the euro. You will always get a price for the US dollar and gold.
Very interesting. A couple minutes ago when you mentioned gold miners and uranium miners, for you, Jonathan, what goes into your evaluation of miners to pick?
Okay, well, again, I need to clarify. I'm simply not clever enough or have the capability or certainly the time, given the work that I do, to look at individual instruments, individual issues. So I only use funds, ETFs or active funds. And the bulk of your listeners, I'm sure, can't access it. So I'm not in any way trying to push anything here. On the contrary, just having a chat. If anyone finds it interesting, that's fantastic. I use a fund at the moment, and indeed for a while in the UK. It's the MFM Junior Gold Fund. And it's got a super manager, Angelos Damaskos. I believe he's Greek or something like that. Super guy. And that fund is, for simplicity, 75-25 in Canadian and Australian juniors. Some of them go into the mid caps. There's some overlap with GDXJ, but it is an active fund. I can give you some of the names that are in there if you're interested. But the fund did extremely well in the mini bull that we had in 2016. In the 7 months, it went up 225%, which is quite astonishing. It hasn't done as well as GDXJ in the next few years. However, it did better in the crash recently and subsequently, and indeed for the bottom, we're up 90%. And as far as I'm concerned, I wrote to my clients on the 24th of March. It's in black and white. I think this fund will go up 150 to 300% over the next 12 to 24 months. That's from the end of March this year. As I say, up 90% by the end of last week, so clearly on its way. Why? Because, of course, the juniors were incredibly unloved for about the last 10 years. The juniors went down 90% from the high in 2011. Gold, of course, went down 45% to the end of 2015. Gold's up from 10. All your listeners know this, but it's probably useful to be reminded. Gold's gone up 70% from 1050 US dollars to about 1750 or so. But the juniors didn't get going as well, whereas they are doing now. And I can tell you, by the end of March, my clients' portfolios were 40%. This is their retirement money. This is real money of real people, not sophisticated traders, people who tweet this stuff all the time. Real money, real people, that they're relying on me, God help me, they're relying on me to secure their financial future. And by the end of March, we had 40% of their money in this fund, and we now have 50% of their money, of their portfolios, in this fund. It can, of course, pull back at any time. But as I say, 90% already, and I think there's probably another 50 to 150% to go over the next roughly 12 months. And for real people, if they've got 50% of their portfolio in it and it doubles, they've just added 50% onto their financial wealth. And nothing would please me more. I am 100% incentivized to get it right, because if they make money, then I make money.
That's a great way to look at it. As we're talking about the gains to be remade by the gold junior miners, I'd like to get your thoughts on the uranium market and what we're seeing, volume starting to pick up and even the spot price gaining a lot of traction recently.
Yeah, gold has still got a long way to go. Gold miners got a long way to go. Uranium. Uranium, as you well know, as all of your listeners will know, it's got to be the craziest market in the world, on the planet. It supplies 11% of global, is it energy or electricity? Either or, it's huge. It's 20% of US energy. I think it's something like 25% of French energy, and so on. And yet the whole mining industry today, after 100% rise in many of these miners, 200% in some of them, since the end of March, the whole mining industry is worth a massive $8 billion. That has got to be the craziest thing on the planet in the investing world. The reasons, I might suggest, are immaterial. My clients often ask me, so why is this, Jonathan? Why is that? And I say to them, well, I could give you a baker's dozen. Do you know that phrase? Is that a British thing? A baker's dozen? Do you know what that means?
I don't specifically know what it means, but I think it's 13, right?
Yes, it is, exactly. The baker used to bake 13 loaves, one for tasting, one for selling. Okay, I could give you a baker's dozen reason as to why uranium miners just were incredibly unloved and made losses for everyone practically for years. However, the simple fact is that in 2018 and 2019, there was almost an exact equilibrium in supply and demand of uranium globally. However, the price still was going nowhere because there was still the secondary supply of uranium itself. But then, of course, COVID-19 happened, and the likes of Cameco and Kazatomprom, they say that they had to close their mines because of isolation and all this kind of stuff. But, reading between the lines and listening to the officials, it seems that actually all they were doing was continuing the process of reducing supply. My goodness, what a reduction it's been. So there is clearly a massive undersupply of uranium now, and for the foreseeable future, to the demand by the nuclear power stations. And that's only going to get worse because demand continues to tick up steadily, whereas the miners have got obviously control over the supply. And if they want to switch more off, then they can do, although I think they've done enough now. So we've seen uranium, of course, go up from $24 a pound to now $34.50 a pound, a very good move. And indeed, as I tweeted last week, just pulling up my chart, it's now broken, as far as I can tell, two important resistance levels at roughly 29.30. $29 a pound was the high in about early 2019. It's also broken above 33.34, which is a breakdown level way back at the end of 2015. And it's just gone straight up. It's practically vertical. And it's unsurprising because the executives at the nuclear power stations must be hanging themselves now, thinking, oh, why didn't we buy more at spot or in term? I mean, why didn't we buy more at term when it was so cheap? Now the power is with the miners rather than with the buyers, as in the nuclear power stations. And we, as uranium mining investors, we hope that that power is used wisely. What was it Spider-Man said? With great power comes great profitability. Wasn't that he said?
I think it was something really close to that.
Yes, I think it was somewhat like that. So, yeah, I'm telling my clients that the Geiger Counter Limited Fund, which is basically the only fund that I can invest in. There are other issues in the UK, but it's the only fund I can invest in. I think it's going to do 500% over the next 2 or 3 years. I think many of the small miners, whether they're actually in production just now or not, I think they'll be 5, 10, 15, 20 baggers, just like 2004 to 2007. But then again, what do I know? That's what the chart is telling me. The price of uranium is breaking resistances. Geiger Counter Limited is going great guns. As I say, it's up 100%. It holds such stalwarts as NextGen, for example, and UEC in a small way, FCU Fission it holds. UEX, I think, is an important one as well. So, it's got all what I would suggest are the guys that, so long as they don't go bust, they should make an absolute fortune for investors. And fingers crossed in a fair wind, indeed the power of the miners, that's what's going to happen. It's all set up. It's just a matter of waiting and letting it happen.
So as we've been speaking about a little bit of a shorter time frame here, Jonathan, what's your long-term forecast going forward?
Well, for gold, let's start off with gold. I've been saying for quite a while, I think more conservatively than most gold bugs, I've been using the slogan 2,500 by 2025. Now, I think that's definitely on the cards. It could be as soon as 2022 or 2023. I think we will see $2,000 this year. It's, of course, not going to be a straight line up. In fact, I wouldn't be surprised to see a barrier at around 1,800. Whether it's a shallow pullback or a more sizable pullback, I wouldn't know. But it's a bull market. It's an uptrend. It's a very strong uptrend for the last couple of years, not counting, of course, starting from late 2015. So 2,000 plus by this year, could be 2,200 by next year. I think those who talk about $5,000, $10,000, $20,000, it's not pie in the sky. That there is a case for it, but I can't currently see it in the first half of this decade. I can see $5,000 in the second half of the decade. And when you think, of course, that the miners at $1,700 US dollars an ounce, bearing in mind the cost of their energy has recently plummeted, and that's 25% of the miners' costs, they're probably making about, on average, this is the juniors, and I focus on the juniors, A, because that's where I'm invested, and B, because the seniors, they were the more stable of the sector. I think people should be thinking about moving from the seniors to the juniors to make more gains now. The seniors have made lots of gains. If the juniors are making, say, $600 an ounce net now, well, clearly they're going to make $1,000 an ounce at, say, 21 or 2,200. Let's assume energy costs rise by then. I mean, that's going to be a phenomenal level of profit. And that will be shown in their balance sheets and then in their share prices. So in the next 1 to 2 years, yes, I'm still looking at another 1 to 200% on junior miners. On the uranium side of things, I mean, in 2007, uranium got up to what, $140 a pound. It seems to me that there's more demand now. There's more power stations. There's more coming on stream over the next few years. Indeed, here we are. We're talking about on the 25th of May. I saw on the 22nd of May that Russia, it switched on and commissioned, actually started the first floating nuclear power station. So it'd been through years of beta testing. They actually signed it off on the 22nd. So that's another nuclear power station coming on stream. And there's more, as everyone knows, coming on, the Chinese in particular. And let's hope that the Japanese also bring theirs back on as well. In any case, demand is rising. And clearly, as everyone knows, with uranium, you can't just switch off and switch on a uranium mine. It takes months, if not years, in many cases. So I am very bullish for the next 2 or 3 or maybe 4 years for uranium. If indeed it is similar to 2004 to 2007, then your listeners need to get on their sunglasses and just look up into the sky, because that's the direction of the uranium price. I see no reason why we couldn't see triple-digit uranium in, say, 3 years' time, 2023. I see no reason why many of these juniors that have been, and this is very important, I like the Geiger Counter Fund because it's investing in the guys who have been through the bear market. In the last bull market, there were 500 uranium companies. It went down to about 30. So we're going to see an avalanche, a flood of new issues coming on stream. Whether or not they have history or pedigree, I haven't the foggiest. But stick with what you know. And if you are going to speculate on the new guys coming on board, make sure you absolutely know what they're about. And if it's your retirement money, don't speculate with too much of it.
Some sound advice there, Jonathan. As we wrap up here, is there any concluding thoughts you'd like to add?
I think I'd like to comment on the U-bugs and the gold bugs, because many of them bug me. To coin a phrase, I've seen them being continually bullish for the years of the respective bear markets. And some people will know that on my Twitter feed, I've been somewhat skeptical. I've questioned their stances, whilst most people were losing money. And, you know, I wanted to say this. Seriously, I've got a great respect. I come to praise Caesar, not to bury him. Great respect for Rick Rule. But I'll never forget, about 3 or 4 years ago, uranium is still in a massive bear market. It still is. And he's in a bar somewhere in Canada. You might even have seen this on YouTube yourself. And he's got lots of investors there and Dev from Vision. I'm going to paraphrase. I can't remember exactly. But he's saying to the investors who are up to their eyeballs in booze, don't worry how much you put in, because you're going to be so rich, you're not even going to think about it. Let me now introduce you to, I don't know, Tina here, who's going to take money off you and get it invested. Well, that, I'm afraid to say, is typical of marketing. And I see it in the newsletters. I see it in many tweeters. They're pushing stuff like drug dealers. And the market had not shown any indication that it was properly coming out of a mega bear market. We have now seen that only recently in the last 2 months. And I've just seen so much bullishness in gold and uranium for years. It's valid now, as far in my humble opinion, it's valid now. But, you know, investors who, you know, listen to your show, who don't produce a newsletter for what they sell. I mean, I do produce the Booms and Bust Report, both in podcast and in written form, but I don't sell it. It's not how I intend to make a living. But for those who don't do such things, who are actually trying to make their way, build their retirement, be highly skeptical of the the bulls, the bugs. It's very difficult when you've got so many bugs around you. It's difficult to be discerning, but that's what you have to be. And one other thing, in terms of the economy, I think it's worth pointing out, it's the biggest recession stroke depression since at least World War II, if not the 1930s. Well, it's two sides of the same coin, really. And there are lots of people out there saying that because unemployment, unfortunately, is going to soar once the idiot politicians reopen the economy globally, because so many businesses simply will not be trading. They will not have sufficient trade to stay in business. Unemployment has already soared, of course, in America. It's going to soar in Britain, in Europe. The economy is dire, but people need to remember, what has the economy got to do with making money in the markets? And the answer is not a great deal. When you've got a central bank in the country just below you putting out 12 to 14 trillion with a T dollars into financial markets, or 95% of it into financial markets, and people are asking, why is the S&P up 35%? That's as far as you need to look. It is a market adage, don't fight the Fed. And yet all these people are fighting the Fed. What's their motivation? Is it are they pushing their podcast, their newsletter? What is it? But I'll tell you what, they're not making money for people, but certainly don't fight the Fed.
Some sound advice there, Jonathan. So I think what you're saying is we need to really question our assumptions and make sure we're not in an echo chamber, correct?
We should certainly do that. I tweeted a few days ago that I actually culled people I was following, who I started following during the crash, to see if I could learn from them. I guess I did learn some things, but you know what? 2 months later, 2 months after the bottom, they're still incredibly bearish. So I've culled them because it's clear whatever they're on, they're not on reality, because all you have to do is look at the chart. And the S&P, for simplicity, or the NASDAQ, they're up leaps and bounds. Gold miners, gold, uranium, there are markets which are up leaps and bounds. So my tip, I guess, would be, if you're following a load of people and they're confusing you, then cull the people who've been getting it wrong. What's the point of compounding the error of listening to them just because, and this is the great thing about the perma bears, they are intellectually stimulating. It's very interesting to hear their rationale as to why. And as I said earlier, who cares about the why? Why did oil go to minus $37? Who cares? What matters is the outlook. How can you make money out of it? Yes, get rid of the people who aren't making you money. Because too many people think we're here, if you're on Twitter, to look good or sound good or sell a newsletter. Fine, maybe that is. But actually, the reason why we're here is to try and make money. God knows I don't do that all the time. If I did, I wouldn't be in Britain. I can assure you of that. But I try to make money. That is my absolute focus. And if you're not focusing on trying to make money, if you're focusing on intellectualing, you get my point, then you're wasting your time. This is not the business you should be in. Go and do a PhD and work in a university.
Excellent, Jonathan. Could you share with us where we can find more of your work?
Well, my main Twitter feed is Jonathan Davis, where the O is a zero. That's on markets. I've been tweeting a lot also about nonsense hashtag COVID-19. That's perhaps for another discussion. I also have my podcast Twitter feed, which is much more political, from a free market libertarian perspective, where I rip apart socialism, fascism, communism, all the isms. Basically, they're all the same ultimately, and that is booms, busts. My booms and busts report, which I send out every couple of months or so, although I have done 2 or 3 recently because of the very major issues we've had in markets and preserving wealth. I send it out free of charge to anyone. Just go onto the website, which is jonathandaviswm.com. WM stands for Wealth Manager, and just subscribe. Even though you may be a sophisticated investor, I am told that there are tidbits in there which are worth reading. It's free of charge. If you don't like it, you'll unsubscribe, and that's fine. So that's where you find me. If you're a professional investor, then I will only perhaps have some interesting tweets for you now and again. If you're a private investor and you're actually unsophisticated and you need help, and you're in Britain or in the EU, then contact me and maybe I can help.
Excellent. Thanks for your time today, Jonathan.
My great pleasure. It's been lovely to chat with you, and I wish you best with the house price crash, which is going to happen in Canada, and we're going to enjoy the same in Britain and in Australia. So in most of the Anglo-Saxon world, we'll have a great deal in common in that respect.
Well, I can't say that's something everybody's looking forward to. Thanks for your time, Jonathan.
It's reality. All the best. Take care.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?